Hi, I'm Attorney Ramsey Bahrawy, and this is Your Money, Your Life. In this segment, we will discuss the role that income investing may play in your retirement planning given the challenges posed by historically low interest rates. Joining me in this discussion is Michael Pansovoy, the president and founder of North Andover Trust Corporation, a company offering comprehensive wealth management services. By way of background, Mike spent a combined 13 years with Kidder Peabody, Payne Webber, and UBS. Thereafter, he established North Andover Trust Corporation, which he has successfully managed over the last 12 years. Mike, welcome to Your Money, Your Life. It's great to have you on the program.
Thank you, Ramsey. Thanks for having me.
Let's start with, what's the crux of income investing? Why do people invest for income, in other words?
Traditionally, people invest in fixed income, as you mentioned, for more conservative reasons. They want a predictable stream of income, and they want to get their money back when the bond, let's say, or a CD matures. Yep. In this environment, things change somewhat. Interest rates are low, and in some cases are too low. For a conservative investor who, in the past, would want some liquidity and keep a portion of funds in the money market, let's say, some in a CD or maybe a municipal bond, it presents a challenge now because the money market rate of return is non-existent. It's barely above 0%. CD in the bank is probably way less than 1% per year. And people are pretty much have a hard time finding a decent rate of return without really risking their capital, something that fixed income investors are usually not willing to do. And that's the issue today.
Okay. So the idea is to create a stream of income,
yes.
and I'm presuming that comes with a little less risk than if you were to invest in other types of instruments?
Well, other types of instruments usually are stocks.
Okay.
Equities present a different opportunity for investors, but it also carries more risk. So people who want income, they technically are more conservative investors, and they want something that will provide a predictable and relatively safe return.
Viewers may not necessarily be familiar with the various different types of bonds. Would you talk to that?
Sure. There are a variety of fixed income instruments out there. Some of them are bonds, and those could be whether government or corporate or municipal bonds. And that, of course, spreads further. It doesn't have to be U.S. issued bonds. It could be foreign government or a foreign corporation, for that matter. And in this environment, interest rates are controlled, or at least directed somewhat, by the Fed. And with interest rate policy at near zero, people are scrambling, and so we can see the stock market is at their high levels, and the bond market is trying to find direction, and at the same time, people are what is referred to chasing yield because they want some kind of return and are being forced to assume more risk than ordinarily they would.
What about real estate investment trusts? Don't they also throw off income, and how are they different from the types of bonds you just finished discussing?
Well, real estate, as implied, it's the entity invests in real estate, whether commercial or maybe a bunch of residential properties, could be medical offices. There are a variety of REITs out there. And as they collect their rents, they, of course, have certain expenses, but then they pass the income to the investors that provide the funding for the REIT.
Now, what's critical for the investor when they're creating a stream of income is, of course, the net amount, the amount they end up putting in their pocket. So when we compare the corporate bond to the U.S. Treasury, to the REIT, to the municipal bond, is there a difference in the way those monies are taxed, and therefore a difference in the net amount that person ends up receiving?
Yes. Some of the fixed income is taxed, and some is deferred, and some is tax-free.
Okay, so which ones are taxable, which ones are deferred, and which ones are tax-free?
For example, if you invest in a CD in your local bank, it would be federally taxed. And if you are residing in Massachusetts and the bank is a resident of Massachusetts, then chances are you will not be liable for the state tax. However, it is still taxed on the federal side, which is the larger portion of the taxation. If you were to purchase a treasury bond, then you would also be liable for the federal tax. And if it's a municipal bond, for example, that is issued in the state of Massachusetts, then you would not pay, likely, federal or state tax.
But that's if you're a Massachusetts resident.
Only if you're a Massachusetts resident and if you're not subject to AMT, which is the alternative minimum tax.
Right.
So the majority of tax probably be not an issue, but there still could be some tax.
Is there a difference in the way REITs are taxed versus corporate bonds and treasuries?
Well, corporate bonds are fully taxable, whether state or federal or any other taxes. If it's a foreign bond, for instance, you could be even liable for some other government tax, for example. However, it's probably a small percentage. Usually, for an everyday person, it's not a big issue, but it is fully taxable. Municipals are usually not taxable, at least on the federal side, and entities like REITs could be tax deferred. So you may purchase a REIT and receive income, and it's not taxable until you sell it.
I see.
So that would be
I
a
see.
deferred income,
I see.
depending on how it is structured.
How wise is it, given today's low interest rate environment in the United States, how wise is it to go out and invest money in foreign countries who may be paying a higher interest rate?
Well, it's often a different kind of risk. Perhaps
Let's
the
talk
rate,
about that.
Perhaps the rate would be higher, and that could attract people, and we see that it does happen. However, all of a sudden, you're looking at a different risk, and that involves political stability in that country. It involves currency exchange, because you are investing in US dollars, and it needs to be converted to that country's currency. And at the same time, the credit rating of that country could be different. So all of a sudden, you're assuming several new risks just to get a little bit more of a return, and often people don't understand what these risks really entail.
Is there enough information about bonds issued in foreign countries for an investor to actually be able to evaluate that information and make an informed decision?
I think it's very difficult to sort through the information that is available. Usually an issuing entity will provide you with a prospectus. However, they can be many pages thick, and it's written in a way that you can't truly understand what the risks are, and sometimes people just assume, just if they heard of the country before, and they think, well, so far it's all right, therefore it will continue to do so. In the investment world, the first thing people need to remember, previous performance does not guarantee future results. And just because some country did not default at this time does not mean they will not do later.
Now, let me move to a similar type of question, but somewhat different. Now, we've been talking about individual bonds issued in foreign countries in the United States. What about mutual funds? Is it okay to be going out and purchasing bonds in other countries if you're working through a mutual fund company?
I think this could be a better choice because it is really a mutual fund company's research department that is doing the job or diversifying for you. They usually trying to find appropriate, by the charter of that fund, investment that fits the criteria. And they have the staff and ability to go through that prospectus and do research about the entity they're about to invest into. And at the same time, when you're buying a mutual fund, that particular investment would be a percentage of the holding, not an entire investment that an individual can make. And the mutual fund company, that is, have an ability to know, at least reasonably in advance, if there are risks that are elevating, and perhaps get rid of that paper before it's too late. Sometimes individuals don't even know when red flags are coming up and may be acting too late if that does happen.
Now, earlier you mentioned certificates of deposits, or CDs.
Right.
I want our viewers to clearly understand, so that this is my question. CDs have risk, right? They're not risk-free instruments.
Right. In terms of investment, including CDs, there is no risk-free investment.
All right, that's the point I want to
Right.
make. There's risk no matter what you do.
Yes.
Now let's talk about other forms of risk that exist out there. Inflation risk.
That applies directly to just the previous question about investing in a CD, because the risk to a CD is inflation and tax. Okay. And even in today's environment, it's quite clear. If, let's say you could get a great rate of return, which is, let's say, double of what is currently available, at 2%. Mm-hmm. And if you look at the inflation that's running at about 1.5%, and a taxation of approximately 25%, all of a sudden you're not making any money.
Right, right.
And
you're actually losing money if your rate is the market rate.
Right.
You're losing buying power, basically, is what's happening.
Right. Your buying power is eroding.
Right, right. All investments have risks. The risks vary. We just talked about inflation risk. How about opportunity risk?
Opportunity is something that people don't want to miss out on. However, that involves a different kind of risk, and in the bond world, it's called credit quality. Mm-hmm. Credit risk can be significant. It's almost hard to know when an entity can either fall back on their dividend payment or default altogether. And different entities tend to behave differently in this particular manner. In the corporate world, the default rate runs approximately 9% annually. So out of all issuances out there in the corporate world, there are defaults every year. Okay. And that's why bonds are rated from investment grade to junk bond rating. So people who want to chase yield, they tend to go into higher yielding instruments. That implies, by definition, that those entities are riskier, mm-hmm. and usually with lesser credit quality and a higher risk of default.
Mike, is it fair to say that more and more money has been working its way into the equities or the stock market because publicly traded companies are paying dividend rates that are higher than the 1% CD rate and higher than the 2.25% or whatever it is Treasury rate? Is it fair to say that that's what's been going on? People have actually been taking on more risk and going into the stock market looking for that dividend payment?
Yes, there is clearly a yield-chasing phenomenon going on, and people are looking for dividend-paying stocks or preferred stocks, mm-hmm. something they can get a return from that is better than what is available locally at a bank, let's say, or in a money market mm-hmm. Company. And by doing so, they have exposed themselves to a higher risk. And the interesting thing about investments, when an investment performs well, people feel comfortable, mm-hmm. yet it does not imply that the risk is not present.
Right.
And it is always important to understand what is the level of risk you want to be exposed to versus, oh, it did well and I'm okay.
Obviously, what people have been experiencing in the stock market, because it's been an up stock market, it's done relatively well, is if you're involved in dividend-paying stocks, you've been receiving a dividend, and on top of that, you've had capital appreciation. So you've kind of had the best of both worlds. Problem is, stock market doesn't always go up. It sometimes comes back down too, doesn't it?
That's right. Especially in a dividend-paying environment, you can buy a stock that, let's say, pays a 5% annual dividend, but in the market, during market volatility, that stock can decline 5 or 10% in a matter of days. Mm-hmm. And so chasing something that will pay you a 5% over a year's time and can drop in value even more than that yield and in a matter of days is a risky bet.
There's no question equities are greater risk than bonds, but yet people have done well with them today.
Yes.
And nobody has a crystal ball, so nobody knows when the market's going to turn. But it's fair to say at some point it will turn.
Right.
Just don't
Historically,
know when.
it does that now and again.
Right, right. We experienced that, in 2008, right, where it was
yes.
a significant correction in the market. Speaking of the correction of 2008, How do you advise clients who have lost significant money as a result of that recession, the Great Recession, going forward? Do you advise them with regards to income instruments or stock instruments, or what advice do you give them, given that they've lost a lot of money?
Well, I suggest that people really evaluate their risk tolerance first. It is very important to know what risk you're exposed to, how much risk you can tolerate, and what is right for you regarding your personal preferences and your time horizon for that investment. And as an example, during the stock market downturn in 2008, stocks definitely went down, and so did everything else. It was a very interesting phenomenon to see that fixed income was mispriced because a lot of trading desks that were involved in bond trading went out of business. And a bond does not trade the way a stock trades. You need to get a dealer's bid, and you have to find out what the price really of that bond is. And interestingly enough, bonds don't trade every day the way stocks trade. Mm-hmm. Out of the entire bond population, so to speak, on a daily basis, less than 2% of bonds that are issued trade that day. And mutual funds in particular, they are required to price the portfolio daily. Mm-hmm. And if a bond did not trade that day, they have to find a similar bond, and if that bond went down, they have to price the bond at that level, and sometimes it kind of presents a distorted view. And that's what happened in 08.
Now let's talk a little bit about a person who's approaching retirement. Is not in retirement yet, but is approaching it, is, let's say, 5 years down the road, maybe even 10 years down the road. Traditionally, the tactic has been to start to move into more conservative types of instruments. Is that still the tactic today, given what's going on with low interest rates?
Well, this tactic sort of got diminished because people live longer, first of all. So they could be in retirement for many decades even. Mm-hmm. And if that is the case, you want that portfolio to grow, because the old rule of you retired and you needed so much percentage of your previous income seems to play out less. People are more active, the longevity has increased, and the traditional retirement instruments of investing are not returning all that much. So people, at the same time, whether they like it or not, are sort of forced into a riskier arena. And that's where I say you have to be very careful to try to understand what is involved before you agree to any type of an investment, because there is risk, and even though maybe it's working right now, does not imply that the risk isn't there.
Well, as I see it, there are quite a few wild cards for people who are approaching retirement. Number one, we don't have any clarity with regard to where interest rates are going.
Right.
So we just don't know. Number two, we don't know what Congress and the future president is going to do with regard to Social Security or Medicare.
Right.
We hear that there'll be reforms, but we don't know what those reforms are going to be, right? We don't know what's going to go on with the stock market. So there's, as far as I'm concerned, there's a lot of wild cards. There's a lot of, guessing that you have to basically do out there when you're an investor. And that's, I think that's got to be difficult for the average person. And I think that's where someone like you as an advisor steps in. And as you said, you work with their time horizon and their risk for tolerance to try to figure out what's the right investment for them.
Right.
But I think if we look back 20, 30 years ago, these wild cards didn't exist. You had a pretty good sense of, interest rates were pretty stable, Social Security was pretty stable, Medicare was pretty stable. Not anymore. Things have changed.
Things have changed. If you are a conservative investor and you didn't want exposure to the stock market, you could go into your local bank and get a CD at a fairly average rate of maybe 4% and say, that's fine for me.
Right.
You can't say that anymore because you don't even get a 1% return
Right.
on your CD.
Right.
And with taxation seemingly on the increase and cost of living on the increase, even though it's not the statistic we hear from the Fed, real life inflation is different than what the statistical inflation is. And so the costs are going up and rate of return literally is at near zero. And that forces people to out of desperation perhaps, seek higher rates of return, and that is really where emotions seem to take over, and it's very important to stay disciplined and create a strategy out of instruments that you understand, or at least take time to understand and learn about it, that you can see what is working for you and why maybe you should be more patient with something instead of being less informed and then be surprised.
Is it wise for an investor at any age to have some allocation in fixed income investments in order to try to smooth out the volatility in the portfolio? Is that wise?
I think it is. I think it is. Fixed income adds, as you said, some kind of anchoring. Bonds have a maturity just by definition, and so yes, there could be volatility, but then these bonds, of course, if they don't default, return your funds at maturity. Stocks do not have a maturity date, and so the volatility can be perpetual. Mm-hmm. You may simply lose your money without a lot of warning, and it's a good idea to have a balanced portfolio. Again, that is appropriate for your personality, your risk tolerance, and your time horizon, your objectives. And past performance, whether it's a stock or a bond or whatever segment in the market, does not imply that in the future it will repeat itself.
Right.
And it's very important to understand that. However, people don't know what the future holds, and they tend to rely on past statistics. And that's where balancing tend to help, because a balanced portfolio tend to be more enduring and wins the race, if you will, mm-hmm. versus creating a lot of volatility, and at the end of the day, maybe it's not performing that great.
So it goes back to the old story of the tortoise and the hare, right?
Yes. The steady wins the race.
The tortoise was steady,
right.
And he won the race. The hare could take off and be really fast, but then he got tired and
right.
couldn't finish the race. You know.
That's right.
Okay, that makes perfect sense. Now let's talk about people who are entering or in retirement. They've got a pool of money that they've set aside for retirement. We talked a little bit earlier about making sure that you have balanced investments, so you've got some income and you've got some stocks for growth and all of that. How should they go about withdrawing the money from their retirement account? Is there some sort of plan for how to withdraw that money?
It's a tricky. In the past, it was easier because the fixed rate of return was a little higher, mm-hmm. and people sometimes would withdraw maybe 4% of their balance and say, well, the markets tend to do better than 4% a year, so I'll be fine. Mm-hmm. Well, that has changed. And so depending on the amount of funds available in the particular case and the time horizon and the age of the person, I think it's important to value all that and look at the particulars and try to figure out what is the right way to create a stream of income, because it is not a black and white picture anymore. It has to be balanced, again, with the risk tolerance and the appropriate type of instruments that would fit that profile to create a stream of income. There is no silver bullet here.
So when you're speaking with a client who's planning to enter into retirement, do you talk to them about what their expected lifestyle is going to be and how much that's going to cost them, and whether they've figured out a budget to make sure that all works? Is that it's something that you do?
Well, I can. However, in general terms, yes, people need to figure out what their needs are, what mm-hmm. their resources are, and how the together will meet. Mm-hmm. And it's important for people to understand that the expenses and the income need to balance in a certain way, and balance with whatever other sources of income they may have, whether it's Social Security or a pension. And they sometimes need to perhaps make changes to their lifestyle in order to reduce the expenses. Right. And I observe people moving to a state that is less expensive. Mm-hmm. The cost of living is less than their current residence, perhaps, or whatever the circumstances, that you find that people are beginning to make these changes. If they cannot create a stream of income to satisfy their current needs, maybe they have to change the environment a little bit, and so on.
I also think it's important that if somebody has a traditional IRA, or if they have a SEP IRA, or they have a 401k, that they have to understand that the amount of money that's invested in that account is really not the total amount of money that's going to be available to them, because they're going to have to pay taxes on that money, right? So they actually are looking at something less than what's in that account.
Yes, by the time you reach 70 and a half years of age, you will start paying some kind of tax on that IRA, and because the minimum withdrawals are required at that, to start at that time, but you have to make that withdrawal, and that withdrawal is taxable at your rate, and of course 100% of that money is not available to you.
People need to understand that if they are in a tax-deferred account, that if they have X dollars in there, they actually, after they've paid Uncle Sam and the Department of Revenue, they actually have X minus.
That's right. And on top of that, there is inflation running, which we mentioned previously. So between tax and inflation, you need to somehow be able to overcome that to stay afloat.
Right. And the critical thing for everyone, I would think, is you don't want to run out of money in retirement. That would be the absolute worst case scenario.
Run out of money, right.
Again, just like you said earlier, with regard to risk, there is no such thing as no risk, and there's no silver bullet either. You know, life is fraught with a lot of uncertainties, isn't it?
Yes, there is a lot of uncertainty in investments, and it's very important to understand that.
You saved for retirement. You took steps to assure that your financial plan aligns with your personal and retirement goals. Yet today you're experiencing the challenges of persistently low interest rates. Interest rates so low that on an inflation-adjusted basis, you're actually losing buying power. Therefore, if your retirement plan is based on interest rate assumptions that are no longer valid, it may very well be time to adjust your plan. While each person's financial needs will vary, everyone does need to review their retirement planning in the context of the current economic environment. Making adjustments to meet your retirement objectives can be fraught with complexity. It is precisely for that reason that one should establish clearly defined goals, balanced by one's risk tolerance and time horizon. Given today's low interest rate environment, developing an income stream can be both challenging and stressful. The key is to stay flexible and develop an effective plan and strategy with a trusted, reputable advisor like my guest, Mike Pansovoy of North Andover Trust, who can help you to create a realistic plan and strategy that incorporates your income needs, lifestyle goals, and current financial condition. Remember, by creating such a strategy, you are making empowered decisions that will benefit you over the long run. In closing, thanks to my guest, Mike Pansovoy of North Andover Trust Corporation. Mike.
Thank you, Ramsey.
Thank you very much. And as always, thank you to you, our viewers, for watching Your Money, Your Life. My name is Ramsey Bahrawy, Building Your Trust.